Good morning, everyone. My name is John Cornwell, and I'm the Director of Practice Development here at Plunkett Cooney. It's my pleasure to serve as coordinator for today's webinar, which is the third and final installment in our three-part series, What to Do When the IRS Comes Knocking. In part one, we focused on the IRS collection process and the two most common collection alternatives, the installment agreements and offers in compromise, which are made available by the agency for taxpayers. In part two, we reviewed additional collection alternatives for taxpayers with unique and complex situations, including first-time penalty abatements, reasonable cause abatements, administrative waivers, statutory exemptions, and bankruptcy. Now, today's session shifts to what many people consider to be a more ominous topic, the IRS audit process. But fear not, we have with us today Senior Attorney Joe Peterson, who will walk us through the audit process and what you need to know to prepare. Joe is the leader of our tax law practice group here at Plunkett Cooney, and I'll introduce him formally in just a bit. So before I do that, I'd like to take just a moment to provide you with some background about our law firm. For those of you who don't know, Plunkett Cooney is based in Southeast Michigan and is one of the Midwest's oldest and most accomplished law firms. We have offices in 7 Michigan cities, as well as in Chicago, Illinois, Indianapolis, Indiana, and Columbus, Ohio. The members of our tax law practice group provide an array of services from business tax controversy and tax planning to personal tax controversy and issues related to state and local taxes, including commercial property tax appeals. Now, as promised, a bit more about today's presenter. For a decade now, Joe Peterson has worked with businesses and individuals to address their tax law needs. His expertise includes dealing with tax collection actions brought by the IRS against individual taxpayers and businesses. Joe routinely advises and represents clients in virtually all facets of tax law, including personal and business tax controversies. His efforts help put his clients at ease, and I could do a little bragging here for Joe because he won't do it for himself. He's literally saved his clients millions of dollars in tax liability. Now, a couple of housekeeping notes about today's program. For the Q&A portion of our webinar, we're going to use our questions window on your GoToWebinar navigation display. Please take a moment to locate the window in your top right corner of your display, and feel free to enter questions as they occur to you during the program. That's the button that has the little question mark in it if you're having trouble finding that. At the end of the presentation, we'll try to answer as many questions as possible. However, I always add one caveat, and that is to please ask questions of a general nature. Discussing specifics or ongoing issues is best done privately, as we are sure you will agree. And finally, I want to mention that today's session is being recorded, and that recording will be available on the event page of Plunkett Cooney's website, which is located at plunkettcooney.com. So with that, I want to thank everybody for attending today's webinar. Now let's get started. Joe, please take it away.
Good morning, everyone, and thank you for attending part 3 of our 3-part series regarding common issues and topics when relating to the IRS and their enforced collection process. Today, we're going to discuss a topic that is the source of a lot of pop culture and is a source of a lot of misconceptions and myths that are common out there amongst individuals and businesses, and that is the audit process at the IRS. For today's webinar, we're going to kind of talk through the audit process and audit types. We're going to talk about what happens during an audit, what you can expect to see from the IRS, from their initial contact through the document collection process, all the way through to when you receive your audit results from the IRS. And then we're going to talk through things that you can do commonly to prepare for the audit, and best practices for what you should do during the audit, and then of course what you can do if you disagree with the audit, and how you can ultimately take steps post audit to kind of button it up, and then things that you can do to prevent an audit in the future if there is such a thing. So the first thing that we need to discuss, of course, is what exactly is an IRS audit. And so for many of you, you'll be very familiar. It's a process where the IRS looks at the tax returns or the tax filings of either an individual or a business. And the purpose of it is to verify essentially what those numbers are on the returns for various reasons. So an IRS agent will initiate an audit, or the system, the IRS automated system, will initiate an audit. And the purpose of the audit is to request additional information from the taxpayer that can be used by the auditor to verify that the numbers as presented on the returns are correct. So very simply, and this is what I have here on my second bullet point, the IRS is literally verifying that the return or the tax filing that was received by the IRS for the taxpayer is accurate and complete. That's really the most important thing to think about when you're trying to frame in your mind what an audit is. The audit will result in potentially corrections to that tax return or tax filing, but in many cases there are no changes whatsoever. So when the auditor gets done with their process, they get done looking at the tax return. Ultimately, what they're going to do is recommend that changes be made based upon what is supported by the documentation. An audit can be, we'll discuss this in more detail as we go along here, but an audit can be in person. There are correspondence audits, and in the post-COVID era, there are audits that take place primarily or exclusively over Zoom. And then along those lines, many audits are completed without the need for any face-to-face interviews or appointments at your home or premises. Many of them can be done simply through email or Zoom meeting. So this is the most common question that I get in practice by the different individuals, the different taxpayers that I run into, whether they be an individual or a business. And that simply is, why am I being audited? Why did I receive this notice from the IRS? I've never gotten one before. Why now? Why are they asking questions about a particular tax return or tax filing that I sent in? And why are they doing it for a certain year? And the answer is straightforward and complicated at the same time. The straightforward piece is that, oftentimes you are simply selected at random. The IRS, and many states for that matter, have automated systems that will randomly select a cross section of taxpayers for audit. And this is done, it often doesn't feel random, obviously, when you get the notice, but I can assure you that there is no intentionality on the part of the IRS or any of the states when they audit you. Your name is simply being drawn out of the hat. You can think of it similar to how jury duty occurs if you've ever been, received a jury duty summons. It's not that the court has deliberately selected you, you were just picked at random. And so that does happen fairly regularly for a large number of taxpayers. You've just been picked at random. And if that occurs, then there's nothing really necessarily to take from that other than you just have to go through the process. There are other things though that will flag you for audit as well, and we'll talk more about those as we move through this presentation. But the general idea is that there are certainly things that can raise a taxpayer's profile and make them more liable to be picked as an audit participant than other things. And then there are the last category that we have on here too. The last two is the IRS does often receive tips from informants of various types. That can be through the DOJ, the Department of Justice. It can be from other taxpayers. They do look into those on occasion. The IRS is not the police. They're not the FBI. They're not the CIA. So they don't function as a criminal catching enterprise per se. But they will do their due diligence. And then oftentimes the IRS will conduct an audit as a follow-up audit to a previous audit that they did before. I see this frequently with businesses. So anecdotally speaking, of course, I've seen businesses who just seem to be audited every single year. They're usually big businesses. So if you're a kind of a smaller sole proprietor or partnership type business, That's not as common, but certainly your big Fortune 500 companies and large corporations, particularly if they're multinational, many of those businesses seem to be picked to be audited on a yearly basis. So that can happen as well. So let's talk through the three main types of IRS audit. So I discussed this before a little bit, but I want to go into more detail here so that if you are the subject of an audit, you get a sense of what to expect. And by the way, your notice is going to often give you a choice between these types of audits. And there's actually kind of it's like a 3A, 3B in here. So I'll talk about those as well. But just know that, oftentimes when you receive your notice, you are given an opportunity to select the type of audit that you want. The auditor doesn't have to grant that request, but you will have some variability depending on the audit and what the auditor's needs are. So the first type is a correspondence audit. These are very, very common. Obviously, they are audits where you receive a request for production or a notice of contact, summary of contact letter from the IRS, and it will include a list of documentation that they need. I've seen some audits where this list is relatively small. I've seen some audits where these are very, very large. These are conducted by mail, although I would say this is kind of the 1A, 1B category. Many of these are now done through email correspondence or by using a secure upload link that the IRS will provide. And this speeds up the audit quite a bit. So if you do a traditional correspondence audit where you are exchanging things by mail, then that 3 to 6 months duration is probably fairly accurate. If you do the email version, again, depending on the complexity of your audit, things can be much quicker than that, quite frankly, and you can often wrap up an audit from the initial phase through to the results phase in a number of months. So that's the first type. The second type is the office audit. That often entails an in-person meeting at the IRS. I've also seen those done as in-person meetings, at the office or offices of the person being audited, which is the third type. It's called a field audit. But the point here is that there is the option to do these in person. So you can have an office audit, you can have a field audit. Oftentimes as well, all three of these are there's a companion to them, which is a Zoom or a conference call meeting that can take place as well. Again, the IRS has sort of transitioned over. They've got a bit more technologically savvy so that taxpayers and auditors can speak by Zoom these days. And I've been a part of that as part of my practice for different clients that have been involved in audits. We have gone on the phone. The auditor has appeared as well. We've been able to share documents that way and talk through things without the need to go to an office, either the IRS's office or the taxpayer's office. Can you advance it one more for me, please? So that we've talked about the types of IRS audits, let's talk a bit more about the timeline. I touched on this a little bit. There is some variability to this timeline right now for a couple of reasons. So before I get into the timeline itself, let me give you those reasons. The first is, as I mentioned previously, technology has come into play more with audits so that there isn't as much of a need to drag things out because documents can change hands much more quickly. Correspondence can be sent back and forth between the auditor and the taxpayer much more quickly due to email and phone calls. So there's less of a need for that. And then the other piece that's not going to be as relevant, hopefully, as time goes on, is that the IRS has had a bit of a reshuffling of the deck. They've had a reduction in their audit staff of up to 30% of reduction versus what it was at the beginning of the year. And so while technology is going to take time off of the standard audit, the lack of available staff might add to the time required for an audit. So, this is going to be a bit of a moving target as we move forward from 2025 into the coming years. But generally, what you can expect is what I have here on this slide. So first and foremost, from the date that the audit is initiated, you're going to have a 3-year statute of limitations, which means once you get that initial notice, the IRS has 3 years to fully complete the audit, meaning issue you final results. If they are not able to do that, they can ask for an extension, the IRS can, but as a taxpayer, you have to consent to that. If you don't provide your consent, oftentimes that will end the audit at the end of the 3-year period. Some audits go that long. For the majority of taxpayers, you're just not going to get anywhere close to 3 years, but it's still a good date to keep in mind. I have here some relatively general bullet points about what these audits, the timelines look like, whether it's a correspondence audit or a field or an office audit. Again, keep in mind that these are very, very general and that there are factors in play at the moment that are either going to take time off of these and make them happen more quickly, or they're going to add time at the back end because of the IRS's limited resources. As with everything, and we talked about during this presentation, much of this is going to be very fact-driven and dependent upon the complexity of your individual audit. Okay, so we talked through generally what the audit types are. We've talked about the timeline. We're going to spend just a moment here in the next 5 or so minutes talking through what the peculiarities and the specific details of the 3 types of audits, starting with correspondent audits. So as I've mentioned before, these are the most common type. I call this kind of a 1A and 1B, like I mentioned before, because of the increasing reliance of the IRS on email and online file sharing sites to eliminate the need to send things by mail. So, keep in mind it can be both. It's probably going to be more likely to be online or electronic than it is by mail, but there certainly is the possibility to do both. Usually when an audit is done in this fashion, the IRS is focusing on 1 or 2 particular items. So what does that mean? Well, 1 or 2 particular items, when you get an audit from the IRS, and this is true for the state as well, or the states as well, an audit is not a broad examination, as it were, of your tax returns for a particular year. It typically centers on very specific things. So for instance, you might get an audit request to examine your 2022 tax return as an individual. So they're going to be looking at your 1040 to determine what the numbers are and to review the data that was used to prepare that tax return to make sure everything ties out, including all the receipts. It might be that if you're a business, you sold your business and you have a large amount of capital gain. Well, the IRS might be looking at that capital gain specifically to make sure that it makes sense from a tax perspective. So, that's what these correspondence audits often look like. They are centered around 1 or 2 topics. The IRS is going to have very specific documentation that addresses that topic, and the topic will likely be confined to a 1 year or maybe a couple of years, but it won't be broad. So that's something to keep in mind for these audits. And we're going to talk about that a little bit more as we move through this presentation, because that fact is very important, and we'll talk about why that is here shortly. So office audits, we've talked about a little bit before as well. These will be for more complicated audits that the IRS is conducting. The IRS will do an office audit specifically when the information that it requires is not easily sent by correspondence, meaning you can't email it to them easily, you can't provide it by mail to them easily, or maybe the IRS has questions about what exactly they need to ask for. So maybe they want to audit a particular return, maybe they want to audit a specific tax topic or item for a particular tax year, but they're not quite sure what it is they want to ask for. They will initiate an office audit. And the real strength of an office audit when compared to the 2 other types that we've talked about is that the IRS can send an agent or agents to your business or your home, and they can literally look through documentation to find what it is that they need. So when that occurs, you're going to be providing them. So again, we'll assume that's for 2022. The agent will show up, the auditor will show up, and they will ask as part of their initial notice, their initial contact, that you make available to them your documentation, broadly speaking, for 2022. The agent will go through that documentation with you or your financial, your CPA, your designated accountant, and your tax attorney if you have one. They will go through the documentation with all parties present, and they will kind of conduct an interview where they are looking at documents, they're collecting certain documents, they're asking questions as they go. And then the point is that when the IRS agent, the auditor leaves, that he or she has everything that they need to fully execute the audit. It doesn't mean that they can't ask follow-up questions, but they're there in the capacity to collect information either verbally or through documentation so that they can get most of the way through their audit. All right, so field audits are really the most comprehensive version of these audits. I actually went backwards here, so I actually was describing office audits as field audits. So we'll do those in reverse as well. So a field audit really is where they come to your home or your business. The office audit's where you go to the IRS. So that one's a little bit different in that you're bringing the documentation with you, but the IRS is still sitting down with you and going over the documentation that you provide to then ask questions. So really the difference between an office audit and a field office, it comes down to location and what the IRS feels that they can reasonably request from you that will address the main thrust of their audit. All right, so this right here is one of the single most asked questions that I have when it comes to audits. Many taxpayers, individuals or businesses, doesn't really matter, are acutely concerned with what they can do to avoid an audit, and more appropriately, what they would do that would cause the IRS to want to audit them. The answer is somewhat nuanced because, of course, we don't know specifically what it is that the IRS looks at when it determines who to audit and for what purposes it looks at them to audit them. But what we do know is that there are certain things that are more likely than not to perhaps cause the IRS to look at returns or tax years with more scrutiny. This is a kind of a comprehensive list here. There are other things as well that will do it, but from a high level, what you have to know if you're an individual or business is that the IRS is going to get quite a few forms that either come from you or are issued on your behalf. If you're an individual, you're probably going to see a W-2 that you get from your employer. Well, your employer is going to issue that same W-2 to the IRS. So I bring that up because if you are an individual or a business where a third party is issuing returns on your behalf and you inadvertently don't include those returns with your own return, the IRS is probably going to ask questions about why it is that they receive something from somebody else on your behalf that you didn't include. And that can be an audit trigger. In many circumstances, the IRS can direct that without the need for an audit, but it can be a clue to them that something needs to be examined on their end to make sure everything matches up appropriately and that the numbers are what they say they are. There are other things in here, deductions, business expenses, rounded numbers. I mean, there's things that you can do that will cause the IRS to kind of raise its eyebrows at you. The message here really is, if you're using good tax software, if you are using a certified public accountant, somebody who you've interviewed and you've checked out and they are holding themselves out as a tax professional and they prepare your returns for you, you're going to avoid a large amount of this because that professional or that software is just not going to let you make these types of eyebrow raising mistakes on your return. But nonetheless, if it's still possible even if you do use those sources to find yourself in that situation. There are also things too that will cause an audit. So, I mentioned this earlier in our presentation, but if you are, you sell your business and you have a large amount of income that comes in and you have capital gains tax that goes with that, there are certainly transactions that will they won't outright trigger an audit, but they will cause the IRS to look a little more closely at your return and potentially could trigger an audit. All right, so we talked about why. This slide's going to talk a little bit more about how. So first and foremost, we talked about the random selection process. The IRS has what's called a computer scoring system. It's called a discriminant index function. I know that's all a mouthful. We'll talk about that real briefly in the next slide here, but know that that's just the automated process that the IRS uses to sift through the millions of returns that it receives on an annual basis. And that system will flag certain returns for additional scrutiny by a member of the IRS. And that member will then, many of them, the individual at the IRS will just dismiss, but some of them, that member, that IRS agent or representative will determine that there is a need for additional scrutiny in the form of an audit. So that's what the random process looks like. It's, again, done just to go through the millions of returns quickly and flag things that look like they might be in the higher risk category. There is also some, I mentioned this too, there are some returns that are just picked at random, just for random sampling purposes. That still happens at the IRS too. Again, it remains to be seen how much of that will be true going forward, given the limitations in staffing. But that's still something that will occur. So again, if you're a party who's selected on that basis, just know that you likely did nothing wrong, and your audit will likely lead to no changes, and that you were just selected at random. Some of the triggers we talked about at the top will also be a manner in which you are selected. So if the IRS determines that certain of those triggers are present, the same process will occur as on the random side. An individual at the IRS will take a look at the returns from a high level and then often flag it for an audit. So if that occurs, you'll receive a notice to initiate the audit as well. All right, so I promised that we would talk a bit more about the computer scoring system. As I mentioned, it's essentially an algorithm that goes through all the returns that the IRS receives. It's looking for abnormal entries. It's looking for things in your return that are not normal when compared to similar taxpayers. So keep in mind, a lot of taxpayers are they fall into very predictable buckets. The majority of taxpayers, individual taxpayers, are W-2 wage earners. They have investment income. They may own a home. They don't have complicated businesses. They're not conducting complicated international transactions. They're very simple and straightforward. That's an example of a category where the IRS would, look at a return that it receives and compare it to see what, this large array of data for other taxpayers that have similar characteristics looks like. And if there's some variance there, that can trigger an audit. This system's also going to look for unusual items or patterns. It's going to look at income levels, deductions, and credits. We talked about those as triggers as well, and that's a common area that I get asked from taxpayers. We'll talk about that more a little bit here too. If I take a certain deduction, or if I take a certain credit, or if my income spikes, is that necessarily going to make me a target for an audit? Well, no, it's not, but it's not nothing either. I mean, it still is something that the IRS will look at, or at least the computer system will look at. By and large, it won't draw an audit on its own, but it's certainly a part of the criteria of the computer scoring system. All right, so now we've talked about triggers, we talked about timelines, we talked about types. Let's pretend that for the purposes of the remainder of the presentation here, that you are selected for an audit. What can you expect? What do you think what can you expect to see the IRS do from the perspective of when they contact you and the audit plays out through to the results portion of it? Well, first and foremost, if you are selected, what the IRS will do is send you a notice. The IRS is a very heavily notice-driven agency. It does the vast majority of its correspondence and interactions with taxpayers via the mail. You will get a notice letting you know that you've been selected for an audit. The notice itself, we're going to talk about types of notices here in a bit as well, but it will outline the audit that is being conducted. It'll tell you the tax years or tax forms that are subject to the audit. It will tell you the name or names of the auditors, and it will also give you options for the type of audit in some cases. We talked about that earlier when we were talking about types of audits. The notice will often give you the option to do it in person or do it via Zoom or electronically, and it will give you important deadlines. It will ask for you to respond to the notice. It's very important that if you are selected for an audit that you take it very seriously and that you understand that you are going to have specific deadlines for response to the auditor. And it's important that you keep those deadlines kind of in mind as you move through the process, because missing those deadlines can often have adverse consequences. So, if you get that notice, the first thing to do is to really read it and fully understand it, and make sure that you counter any deadlines that you need to keep in mind, and that you understand what the documentation requirement will look like so that you can prepare to gather those documents. All right, so these are the types of audit letters. I'm not going to go through these in great detail. I'm going to highlight a couple here. So the first is the letter 566. And these numbers, by the way, are all going to be at the top right-hand corner of the notices that you get from the IRS to really kind of help you understand exactly what the type of letter is. So if you get a 566 letter, that's going to be your initial contact. The letters in the middle there, the 525 and 3572 have to do with the type of audit that the IRS would like to conduct. The letters at the back, the 4564, 692, and 886A, those are all results letters, and they're going to tell you what the auditor ultimately found. So an auditor really can go one of two directions, and that is to say that they've conducted their audit and they have found that there are changes that they need to make to some of the numbers. Some of those changes can be positive, by the way. Not all of them are going to lead to more tax for you. It might be that they conduct their audit and determine that you've overpaid your taxes, and in that case, they'll issue you a refund. But either way, you're going to get an explanation of examination changes form if that's the case. If it's not the case, then you're going to get a form or letter that basically says that there's no changes, and that will either of those forms will effectively conclude that portion of the audit. All right, so you've been selected, you've gotten your notice. What happens next? Well, the IRS is going to they're going to contact you, essentially. That's how that's going to work. So you're going to get that letter. The IRS agent may contact you directly as well at that point. We've talked about this just a little bit, but the point of that initial contact really is to fully understand why you've been audited, what documentation is going to be required, and give you an opportunity to marshal the resources you might need in the form of your CPA or tax attorney, and then to start to send those documents over to the IRS agent. All right, so this is the gathering relevant records portion of the presentation. So what this basically portends to is that the auditor is going to request some form of documentation. That documentation the list for the documentation might be small, it might be very, very large, and it will all depend on exactly what it is the auditor is auditing. So I will talk through this, but before I do, I want to issue a word of caution here. Many taxpayers want to go about an audit in good faith, and you should. That is not a thing that you should avoid doing. But the auditor does have discretion to broaden their audit if they receive something in the documentation that leads them to believe that they should investigate something further. I bring that up because a common mistake that clients of mine make is they get that initial contact letter, it has documentation, they're upstanding taxpayers. Their belief is they've done nothing wrong, and they have every intention of complying with the IRS request for documentation and to move through the audit as quickly as possible. Those are all very commendable goals, but the word of caution is that you have to be careful. And it is at this point, the documentation and the initial contact point, that it really pays to have a tax attorney or tax practitioner in your corner who can really look through not only the initial notice to fully understand what the audit is for, but also the documentation that you're providing to make sure that that documentation is very specific to what's being requested and that it addresses fully the audit without going further than that. Because clients often, to their own detriment, provide documentation that expands the audit out. And that can be, in many instances, at the very minimum, it's going to be a greater impact from a time and documentation perspective to conclude the audit because now you've expanded it out. But it can actually lead to a lot more problems down the road as well. So when you're gathering your records, when you're getting everything ready to go, the single most important thing I want you to take away here is it absolutely pays to have a CPA or a tax professional like a tax lawyer brought into the audit at this point so they can start to go through the documents with you. So what kinds of documentation will you need to gather? Well, it's going to depend greatly on what the audit is for, but if we're presuming it's for just your annual tax return, if you're an individual or business, you're going to need the things that you would use to prepare that particular tax form. That's kind of the rule of thumb. So, that's going to include things like receipts, canceled checks, bank statements, legal papers. If you had something significant happen in your life, maybe you adopted a child, maybe you had a divorce, maybe you bought a house, things of that nature, you're going to need to have those available to show to the auditor. Any employment records that you have, keep in mind that the IRS will likely have those things as well, particularly if it's like a W-2 or a 1099 or something of that effect. And then any other investment statements that you have for brokerage accounts or IRAs or 401ks or whatever the case may be. So once you've gotten your list together, you reviewed your notice, you know what the audit is for, you've identified the categories of documents you're going to need to collect. The next step will be to organize those financial documents or the documents in general in a manner that makes sense so that you can give them to the auditor. So, there is a movie called Stranger Than Fiction. It's got Will Ferrell in it and Maggie Gyllenhaal. If you remember that movie, she deliberately gives all of her tax forms to Will Smith's character, who's the auditor in the movie, and she puts them all into a giant box and they're disorganized. That type of thing looks really great in a movie. When you do that in real life in an audit, it can cause significant problems. And the reason for that is because first and foremost, it's going to delay your audit out a significant amount of time because the auditor is going to have to go through all of that. But the second is that by not knowing what you're giving the auditor in that way, if you don't have things properly organized, it can lead to an expanded audit. It can lead to you giving the auditor more information than they're legally required to get from you for that audit. It can cause a whole host of things. So, don't do that. It's the number one thing. But, when you've got your compiled list of things that you're going to turn over to the auditor to respond to their request, make sure that you organize it. Have some semblance of structure to what you're giving them and why you're giving it to them. And make sure that you document everything that you turn over so that if there's some question down the road about, well, you didn't give me this or you didn't give me that, you can go to your list and you can say, well, listen, I know, the things that you have are on this list. I've dated it. We know with certainty what was provided, how many pages were provided, and so on and so forth. So make sure that you're organized. Make sure you take it very seriously. All right, so this particular category is very important when you are being audited. So a lot of audits do involve annual tax returns. It's a good idea when you are getting audited, when you're being audited, that you pull up whatever the tax return or tax form was that is the subject of the audit, and you just give it kind of a once over to make sure that everything looks okay. And oftentimes for many taxpayers, that's going to involve bringing in the preparer of that return, whether it be a CPA or a bookkeeper, maybe somebody that works for your business. Sit down in a room, get the return out, go back over it, make sure everything looks okay, make sure that you don't have any subtotals in there that don't have any itemized information that can be the subject of that can cause an audit. Make sure everything looks okay. And if you discover an error, make sure that you're prepared to explain it. Make sure that when you go into the audit, whether again it's telephonic or by email or it's through some sort of a meeting, it's always in your benefit to point it out before the auditor finds it, to say, hey, listen, we've gone through the return, we've identified a couple of errors or omissions, and we want to identify those and kind of justify why that may happen, and or correct it just in real time to say, yeah, look, we can save you some time here. We do know that there's a couple of little issues that we've identified. That can be a really good thing. And again, not all those corrections are going to cause a tax balance to be due. Some of them might actually be in your favor. So do that ahead of time. Make sure everything looks okay on that return before you go and meet with the auditor. We talked about this before, but I really wanted to highlight this. This is why we have a slide for it. Make sure that you understand in great detail what exactly is being audited. Do not provide more information than is actually being requested as part of the audit notice. Why this can be important is if we presume for a moment that you're a business and you file a 941 return. Well, a 941 return is a quarterly return that documents the deposits that you receive on behalf of your W-2 employees. Well, if the audit is only for quarter 1 and quarter 2 of a particular year, and you provide the IRS with all of the quarters, all 4 quarters, well, that's beyond the scope of what the audit is. And again, you provided more information to the auditor than they're legally allowed to receive. The auditor is going to look through everything you give them, regardless of whether it is responsive to the nature of the audit itself. That's important to remember. They don't have to go through it, but they're likely going to look through everything you give them. So, it's just fair baseball here. You don't need to go beyond the scope of what the audit is. You're not required to do that. You should aim to give the auditor as much as they are asking for, or as much as they might need to fully execute their audit, and you should aim to give them nothing more than that for the purposes of protecting yourself from liability. So make sure when you get that notice, and you can, again, go through this with a tax practitioner, go through this with a tax attorney, make sure that you fully understand the years that are being audited or the tax periods that are being audited, and what about those tax years or tax periods the IRS is specifically focusing on before you send them documentation. So I've mentioned this before. I won't go into it in a whole lot of detail. It is always a good idea to consult a tax professional. It's never too late. It's never too early to bring in a tax professional that can talk through the audit with you, what's being asked for, what you can expect, and that can review your documentation before you send it to the auditor. All right, we talked about this one as well. You're going to have at various points in time, deadlines that the IRS agent, the auditor, will send to you either to respond or to provide additional documentation. There are going to be meetings that are involved in the audit. I would just encourage you to buckle up, because the audit is going to be, there's going to be periods where there's a lot going on with the audit. There's going to be periods where you're waiting for the auditor to go through documentation. Regardless of what's happening, make sure that at no point the auditor is waiting for things from you, unreasonably waiting for things from you, because again, that can cause problems in the audit process, and it oftentimes will allow the auditor to do things that potentially you're not going to like. So make sure that you're very prompt in responding to IRS requests. We talked about this one too. I'm not going to spend a lot of detail here, but again, make sure that you are being very concise with your answers to the IRS, whether that be by the documentation you provide or in your answers to interview questions as well. Don't overspeak. Make sure you know what you want to say before you say it. Make sure that what you say is responsive, and that you don't go beyond what the scope is of the actual audit. So at all points during the audit process, it is important that you as a taxpayer remain engaged with the auditor. And that means that you're having a two-way conversation. I'm not suggesting that you need to record them if you speak to them, but make sure that you have a good sense of what the record of events has been, chronologically speaking. When did you get your notices? What notices did you receive? What was said on those notices? What documents did you provide the IRS? When you received written requests for more information, what did those requests ask you for, and what were your answers to those requests? All of those things are things that you should keep for your own records, so that if you need to appeal the results of the audit in the future, or if this audit ever comes back up for any reason whatsoever, you can look at what you have gathered, not only documentation you provided, but the correspondence from the auditor, him or herself, and you can reference all that to say, listen, this is what's happened here. This is the order of things, and it could be something that can ultimately help you in the future if there's any need for it. There is a common misconception, I think, and maybe I've even given this off even in this presentation, that you should be adversarial to the auditor. I don't think that's true. The IRS is certainly not the boogeyman. They have a complicated job to do. An auditor is likely there to, go through the forms, but they're not the police necessarily. They're not there to throw you in jail or take your business. It is important to, always be professional and remain honest and courteous when you're dealing with the IRS auditor. They have a lot of discretion too, in terms of what they investigate, in terms of what their findings might be. They have to stick to the facts. Obviously, they can't make things up, but it is definitely in your best interest and will make the audit much more, it has the potential to make it, I would never say enjoyable, but certainly a bit more worry-free when you have at least a good working relationship with that auditor. So, do with this as you want. You got to feel it out, obviously, with the auditor, him or herself, but in my experience, it is certainly beneficial to be professional and to be straightforward and honest dealing with the auditor, to answer their questions and give them what they're asking for, because they do have a legal right to audit you, the IRS does, and they have a legal right to request documentation as part of that audit. So it's best just to treat what they're doing with that level of professionalism, and that will ultimately lead to better results for you at the end of the audit. We did talk about this a little bit beforehand as well, but I just want to emphasize, as you're going through the audit process, you should be looking at documentation as well. You should be interacting with what the auditor is saying to you in terms of what they're looking at or what they're finding. It's not a bad thing to reach out to them, to ask them if there's anything that they need from you that, again, addresses the audit itself, or if they have any particular questions. As part of that, when you're going through the documentation or you're responding to those requests from the auditor, if you uncover anything, a mistake or an omission, maybe a tax form that you didn't send in or anything like that, discuss it with your tax attorney or your tax preparer first, of course, but it shows good faith on your part to say, listen, we've uncovered this error, and it gives you the opportunity to provide context or an explanation before the auditor finds it. And that good faith, that ability to kind of head off issues, can really go a long way with the audit itself. So, I'm not telling you need to immediately rush over to the auditor the minute you find something that's wrong, but I would certainly take a look at that and discuss it with your professionals and see if it makes sense to talk to the auditor in advance to say, listen, there is something here that we have uncovered in the documentation, and we want to take steps to fix that with you as part of the audit. All right, so we talked a little bit about the forms before. One of the things that you're going to get at the conclusion of the audit is an IRS audit report, and that audit report is going to it's going to be potentially somewhat detailed, and it's going to do a couple of things. First is it's going to show in a side-by-side comparison the tax form. So if we presume that this is an annual income tax return, it's going to show all the numbers that were on the initial income tax return. It will then show the line item adjustments that the auditor made to what was originally filed. And again, keep in mind, some of those adjustments are going to be positive, some of them are going to be negative, but it will show you in great detail what those adjustments were. Oftentimes there will be sections where the auditor provides a paragraph or paragraphs as to why they made those changes. Oftentimes they will cite tax statute. Oftentimes they will cite individual IRS guidance in the form of private letter rulings or regulations that were issued by the IRS that deal with that particular topic or subject. The point is that you're going to get an 886A letter. It's an examination report, and it will be very, very detailed in terms of what the auditor did and what their ultimate findings were. I encourage you to spend some time with that form, whether it be with a tax attorney or another professional, to really, really go through it and understand exactly what it says and whether or not you agree with the results. Because ultimately, if you don't, you are going to have the ability to appeal it later on. And here we are. This is the appeals portion. So you do have 30 days from the issuance of the audit report to file a protest. It is very, very important that you do not miss this 30-day deadline. If you miss it, the results of the audit become permanent. So when you get that, make sure that the audit results are going to have detailed information about how to file this protest. An IRS attorney or a tax attorney is going to know how to do this as well. But make sure that you take that report seriously, you digest the findings, you determine if you disagree in any respect to what the auditor's results were, and that you file that appeal as soon as you can. Oftentimes, an appeal will end up in U.S. tax court. Tax court is the appeals forum once you leave the IRS proper. So I won't go into great detail about the differences between the two, but ultimately know that the tax court's an independent forum. It is separate from the IRS and the Treasury. You're not dealing with IRS agents in tax court. You're dealing with IRS staff attorneys at that point, and that you ultimately are going to be. It's a legal proceeding. So a CPA, a bookkeeper can't ultimately adjudicate a case in tax court for you. A tax attorney is what you're going to need to do that. But oftentimes you can get relief for adverse findings as part of an audit much more quickly and in a way that you're going to feel is more fair to you by taking your case to tax court. All right, so we've talked about the forms, we've talked about the adjustments, we've talked about the ability to appeal. What happens next? Well, if you get a form that says that there's no change or adjustment as a result of the audit, well, congratulations. The audit for you is over. The IRS will not come back, and it cannot come back and re-audit you for the same tax period for the same reason. So you can effectively close your books on that particular tax year for that particular, the audit purpose itself. And you don't have to worry about any adjustments. There's not going to be any changes to your tax return for that particular year. All right, so as part of the process, and we talked about this a little bit too, so we'll move through this really quickly. The IRS during the audit process is going to be looking specifically for accuracy, supporting documentation, compliance, income verification, and then they're going to look at your expenses to make sure that everything is appropriately categorized. So this right here, this slide is really meant to kind of give you a sense of what the IRS process is. We talked about the overall process, but when you get down in the weeds with the auditor, him or herself, what are they actually doing? This is what their checklist looks like from a very overly simplified perspective. One of the key things I want to draw your attention to here is two separate things. The first is one of the areas that people often get in trouble with is income verification. The IRS is going to want to make sure that you've accurately reported all your income. It can be easy to not do that because you miss a form here or there at the beginning of the year when everybody's sending out their tax forms to the various people that require them. It's easy to miss one. And then the second one is, particularly if you run a business, are you commingling your expenses? If they are expenses for you individually, they are not tax deductible. And that's something that a lot of business owners, particularly if you're a single, a sole proprietor or you're operating as part of a partnership, oftentimes these expenses get commingled. That can be a major issue. So the auditor is going to spend a lot of time, particularly if they're auditing somebody who owns a small business, looking through those expenses to make sure that they're proper. One of the items above as well is income underreporting. We talked about this a little bit. Just make sure that everything that you need to report is adequately reported on your tax return. That's going to include W-2s and 1099s. It's going to include income that comes from foreign sources or that you receive as part of freelance work that you do. Some professions are going to be more likely to see this happen than others, but just make sure that as part of your initial review when you get that notice that you go through to make sure all the income that you receive for the year is adequately reported on your return. Incorrect deductions or credits. So a lot of taxpayers get really, really anxious when it comes to taking certain deductions or credits, particularly if they're a little bit outside of the common credits or deductions somebody might take. A key one of these deductions that I see coming up often that can trigger an audit is home office deductions. There are very specific rules about when you can take a deduction for home office. If you do take a deduction and it's a big deduction, that can be the source of an audit. But as I discussed earlier, generally speaking, you are permitted under law to take incomes or deductions and credits as outlined by the IRS statutes on your tax returns. By doing that, you're not putting yourself in a position where you're more or less likely to be audited. But doing them incorrectly, that's where those issues can come into play. And the IRS is set up in such a way that it will identify, not always, but commonly identify when those issues arise. Record keeping problems. I mean, this is again a common area. If the IRS initiates an audit and you send them your documentation and there are large gaps or there's sloppiness in the way that things are notated in your general ledger, maybe you have outlays of expenses that you're taking for certain things that you need for your business. Maybe you are doing certain things as an individual. You're selling a car, and there's indications that the car was sold, but it's not fully documented properly, or there's just no business records to speak of. You're going to have major issues there, and oftentimes if there's any doubt on the IRS's side that you can't, that the numbers on the return are proper, the IRS is going to default to the idea that you have to be able to support the numbers on the return. So if they can't substantiate what's on that return because of missing or incomplete records, odds are pretty good that they're going to disallow whatever that adjustment might be. So make sure that your record keeping is very tight, both now and for the purposes of the audit. This slide is specifically for issues with self-employed taxpayers. These are, again, your small business owners who are running businesses. You can find yourself in some hot water. There's a lot of different things in here. We talked a little bit about commingling of expenses. Just make sure that you understand as a self-employed taxpayer that you're going to be scrutinized a little bit more because of how intimate running a business really is. More so than a taxpayer who's just a W-2 or a 1099 person, and more so than a large corporation or even a medium-sized corporation that has a whole staff of CPAs and people that are working on behalf of the business. And that's because the IRS finds a lot of issues, generally speaking, or the data supports that there is often a lot of issues in the reporting and in the returns that are filed by self-employed taxpayers. So this slide outlines some general issues that are commonly the source of an audit for a self-employed taxpayer. I won't go through them in a great amount of detail, but just know that these are subjects that as a self-employed taxpayer you should really be focused on, again, both now going forward and then in any audit requests you receive from the IRS. All right, so I have one slide in here. We talked about a little bit before, communicating with the IRS examiner. Make sure, again, that you are very studious with the record keeping that you do in terms of all the requests and all the notices that you received, and that you stay very focused on what the auditor is requiring. You do have a right to have the auditor be courteous to you as well. So, if things get off the rails, you feel like the conversations are going sideways for any particular reason, you certainly have recourse in that area too. You're not, as the taxpayer, subject to abuse. You should never hear the auditor refer to you as the defendant. You are not a defendant. You are you're a taxpayer. You're not guilty of anything until, and even if you did make mistakes on your tax returns, you're not guilty. That's not against the law. So, make sure that you're being treated with respect as well, and that you're treating the auditor with the respect that they're due. You always have the right to representation. So I included this slide mainly to highlight that point for you. Regardless of what the auditor might tell you, regardless of what their notices might say, you are always allowed to bring in representation at any point in the audit. So, I highly encourage you to do that. As I mentioned, In this particular case, an ounce of prevention is always worth a pound of cure, in my experience, when it comes to an audit. So, make sure that you avail yourself of that when you have that opportunity. You also have a right to confidentiality and privacy. So these are all slides that talk about, what you can reasonably expect during the audit. When you send in forms, when you provide correspondence to the auditor, when you give them, intimate documentation if you're a business about how you run your business or what the numbers look like. The IRS auditor, generally speaking, is going to be very careful to treat those documents or the things that you disclose as part of the audit with the respect that they deserve. But make sure that you always feel comfortable that the auditor is preserving your right to privacy. That's the most important thing here. So I'm not going to spend a lot more time on this. Generally speaking, you're not going to run into any issues, but just be aware that the auditor should be acting in a way that doesn't put you or your information at risk as part of the audit. So this is the big one, and we're going to end on this slide here today. How do you prevent audits in the future? Well, we've been talking about some of this stuff as we've gone along, really. The key things I want to highlight here is, first and foremost, it is always a good idea, if you're not sure about your returns and the things that you're filing with the IRS, to hire competent professionals, whether that is a CPA or an accounting firm or a tax attorney. If you're looking to, you're thinking about a complex transaction, it's never a bad idea to be prospective and bringing in professionals to talk through things before you file your returns. That right there can keep you out of an awful lot of trouble, because those professionals are going to be able to think through things in a way that prevents the IRS from kind of getting, triggered in terms of what you're filing. Making sure that you send in your returns on time, that what you send in is accurate and complete, that you keep good records, and that you're very studious. We talked about that before. If you are sloppy in your record keeping, if you are putting numbers on the return that can't stand up to scrutiny because they're rounded, because you just don't know what the numbers are, that can cause an issue. And that the deductions that you take and the credits that you claim are reasonable. Again, if you have a home office, if you take a giant deduction and the IRS is going to know what they can look at what your home office looks like, what the space is, they're going to know what's common for the area. You take a giant deduction, that's going to be a trigger. So I guess the overarching method here, or the message here for preventing future audits, is use common sense. If you're doing things that make sense generally, and you're doing your due diligence to make sure that you're not overstepping, that right there is going to keep you pretty far clear from future audits. Beyond that, like I mentioned, there's going to be random audits that occur. And so in those circumstances, you just can't prevent those. But by taking these steps, you're going to put yourself in the best position to both prevent audits and to be able to respond timely to those audits when they do occur.
Oh, I'll jump back in here. The time's come for our Q&A session. Joe, great job covering an awful lot of information. I'm sure people are really thinking about all the issues you've highlighted. So I want to just open up the floor to questions. And as a reminder, we're using our GoToWebinar questions window. It's the question mark button at the top right of your screen. So what I will do is take the first question, and it is, does filing a certain way or claiming certain credits or deductions make me more likely to be audited?
Yeah, thanks for the question. I appreciate that. We talked about that a little bit before. This is a common area of stress for taxpayers. And the short answer is no. The tax code allows taxpayers to take credits and deductions. It's an integral part of our tax system. So, taking those credits or deductions is entirely appropriate, and the IRS expects that you're going to do it. What you want to be careful of is that you don't take unnecessarily large credits that are outside of the norm of what would be expected, or you want to make sure that you do your due diligence. If it's a credit that is a little unique, or maybe is one that you don't understand fully, or maybe has some complicated reporting requirements. An example of that might be, electronic vehicles, which I think is being sunsetted out here in the next year or so. But there are certain reporting requirements that go into taking a credit for an electric vehicle.
you have to have bought it within a certain time frame. It has to do certain things. You have to do certain things at your home, I believe. So, make sure that you understand what the credit is if it's a little unusual. But by and large, the normal credits that you can take as a taxpayer are credits that the IRS is going to expect you to take, and they won't trigger an audit by themselves.
Great, thanks for that, Joe. Next question is, what is the best way to approach a document request and initial correspondence with an auditor?
Well, so the best way to do that is to, again, make sure that you fully understand what the document request is, and that you digest exactly what the audit is about as well. It is never a good idea, in my view, to not have your house in order, to have no plan and just reach out to an auditor directly unless you're just saying hi, giving them your contact information. Because again, an audit can go a lot of different directions depending upon what you give that auditor. And so while you want to make sure that you're responsive to what they're requesting because they're legally allowed to do it, you don't want to over disclose. And so I would encourage you, if you are thinking about the best way to kind of go through that initial document request and have that first correspondence, make sure that you have everything in order and you know what you want to do. And the best way to do that really is to talk to a tax professional, a tax attorney, to kind of go through some of that stuff so that you really have a good plan before you make that first contact.
Great, and this is the last call for questions. So I have one more in the queue, and if anybody else has any, please add them now. This one is, my auditor seems to be asking for documents and returns that are outside the scope of the initial audit letter. What are my options for addressing this with the auditor?
Well, so when this happens, this is when audits can go sideways potentially. Auditors often feel, and some of them can have a feeling of entitlement when it comes to requesting documents, but keep in mind that you are not required to give them documentation that goes beyond the scope of the audit. So as an example, if the auditor is auditing you for 2022 and they make requests for your 2023 tax returns, well, they've got to, they can't just arbitrarily do that. There has to be a reason beyond just the initial audit itself to go and ask for more information. It's never a bad idea to politely ask them for why they're asking for the documentation, and then to push back if you feel like they're not entitled to it. That will often require that you bring in, more adequate representation in the form of a tax attorney or a CPA, though, because they'll be able to speak that language with the auditor. But just know that there is not a requirement for you to provide anything above and beyond documentation that is responsive to what the audit is the subject of the audit in the first place.
That's great. Thanks, Joe. I don't see any other questions. So I think we're pretty much at our time as well, maybe just a little over. So I think it's time to just wrap things up. So with that, I just would like to let everybody know that at the end of the program here, where you'll see a pop-up survey from GoToWebinar. We would really appreciate it if you take a few minutes to complete it. We always love getting your feedback and your ideas for future webinars. So please indicate any topics you'd like us to address down the line. We do read all of those surveys. The other thing I would like to mention is that in case you or a colleague would like to review today's session online, you could do so by visiting our event page on the firm's website, which is located at plunkecooney.com. At the top and bottom of each of our archived event pages, including the one for this program today, we include links to our recordings. So you can find our previously recorded webinars for free at your convenience. So I point you to the website, our Insights tab, and then you can find our events from there, and those are available to you for free at your convenience, 24/7. For those of you interested in staying up to speed on tax law issues, as well as information about trust and estate planning topics, we invite you to check out our Legacy Law blog. It can be found under the Insights tab as well on our website. Again, that web address is www.plunkecooney.com. So with that, I would like to conclude today's program on behalf of myself, Joe Peterson, and the members of Plunkett Cooney's Business Law Department. Thank you for attending today's webinar, and have a great rest of the day.